Welcome back. The sell-off is deepening now. It's 162 points lower, and from the day's high, it's a lot more, close to about 220 points gone from the session highs. The Nifty is down 160 points. Keep your eye on some names where the selling pressure is picked up. ONGC is down 1%. Adani Ports, Eicher Motors, Adani Enterprises, across the board. Power names are weak. IT is selling off. Tech Mahindra is down close to about 2%. And Coal India continues to bear the brunt of selling pressure. 3% gone today. And this week itself, in the first 3 days, Coal India is down close to about 10%. But the losses are being led by the oil marketing companies. So BPCL is the top laggard on the Nifty, 3.5% gone on that. Vivek is here with us. There was a recent note by Spark where they've downgraded oil marketing companies. Vivek, we've had a slew of upgrades, and this appears to be the first downgrade that we've seen on oil marketing companies. Is it just the valuation, the run-up?
Well, absolutely. A lot of interesting points that, Spark has mentioned. So, number one, like you mentioned, quite a lot of upgrades on the street coming in as far as OMCs were concerned. Along with that, remember, a very large new fund has actually come in as far as the OMC or the energy space is concerned. So, SBI Energy Opportunities Fund, they were looking to raise just close to 4,500 to 5,000 crores, managed to garner well over 6,000 crores in this new NFO. And what does the scheme say? The scheme is actually that they would largely be investing in the oil value chain, that is both upstream and downstream, new energy, power, as well as power infra. So that has also been one key trigger as far as the entire re-rating in the space has been concerned. But today, Spark Institutional Equities, has actually looked at both the fundamentals as well as the valuations, as well as the stocks run-up that has been seen in the recent times. They've turned negative on OMCs. They have a reduced rating on BPCL. They have sell ratings on both HPCL as well as IOCL. They're saying that the global disruption-led diesel as well as GRM spikes at this point of time is not sustainable. Remember, diesel cracks are at an all-time high. They're also saying that multiple data sets that they've been tracking indicate that easing diesel supply and in turn, on back of that, cracks could revert back to the $20 per barrel mark. They're also saying that the maximum impact as far as the Red Sea disruption is concerned is already in the cracks, and on the back of that, you would see that receding further. They believe stocks are now pricing in $9 to $10 per barrel worth of GRM for FY26. At this point of time, risk reward is not favorable.
Okay, interesting. So we finally have a bear as well. Lots of bulls on OMCs, but we've got that bear call coming in as well. Vivek, thank you very much for that. Prakash, let's